Hi, I'm Jonathan Shepard from the University of Kentucky Department of Agricultural Economics in the College of Agricultural, Food and Environment. And I'm here today to bring you a video on tax considerations for new beef producers. This is part of our Beef Business Foundation video for new producers, and it is funded by the Ag Development Fund through the Kentucky Beef Network. So today we're going to talk a little bit about depreciation, how to manage depreciation, how do we account for market animals versus breeding livestock, and the tax implications between the two. And then we will also talk a little bit about how accounting differs for raised livestock versus purchased livestock. Depreciation is a term that we hear a lot, and there's really two types of depreciation that we deal with. Economic depreciation is the actual loss in value of an asset due to wear, tear, use, and technical obsolescence over the useful life of the asset. It is tied to the actual use of the asset, and typically whenever you're looking at economic depreciation, there's a salvage value associated with the asset, even if that salvage value is scrap value at the end of the useful life of the asset. On the other hand, tax depreciation, while the concept is the same, is bound by the rules and regulations of the IRS. And in essence, to capture the loss in value of assets in a uniform manner across all taxpayers. The terminology class life, which is how long you expect the asset to last in the use of your business, oftentimes under the IRS regulations do not pair well with reality. It's important to remember that with tax depreciation that there are these very specific rules that the taxpayer must follow in order to be in compliance with the Internal Revenue Service. What we're going to talk about from here on out is the tax depreciation component. The economic depreciation is another discussion for a different day. As you can see, Table 7.1 here, Farm Property Recovery Periods, this was taken directly out of the IRS Publication 225, which is known as the Farmer's Tax Guide. This was from the 2021 version. And it gives us two different types of depreciation systems. But right now, just look at the two columns that show the recovery period in years. And so you can see things like automobiles are 5 years under both systems. The farm buildings are 20 or 25 years depending on which system you're using. Machinery and equipment is 5 or 7 years depending on whether it's new or used. And so once again, this is to make uniformity across all taxpayers, but does not necessarily pair well with reality as far as how long you actually expect an asset to last in many cases. When it comes to tax depreciation, there's some basic assumptions that are implicit within the IRS rules. The first is that there's a zero salvage value assumed on all assets. So in other words, as the taxpayer, you get to depreciate all of the cost associated with that asset. When it comes to cattle, bovine, breeding livestock, that's a 5-year class life as determined by the IRS. So that means cows, bulls, heifers all get depreciated for 5 years. Most equipment's going to fit into either that 5 or 7 year category. Also, most farmers are using the MAKER system, which is the Modified Accelerated Cost Recovery System, which is a 200% declining balance depreciation method. The Tax Cut and Jobs Act of 2017 allows for a year-to-year class-by-class selection to use other methods. So taxpayers do have the option to choose between the Modified Accelerated Cost Recovery System with straight line or the alternative depreciation system. And so this is something that we want to keep in mind, that we do have some opportunity there to slow down depreciation in instances where it's warranted by switching to a different depreciation system. So here's just a common scenario that I've seen. A lot of young and beginning farmers may struggle to show profit because of many factors. Oftentimes it's, a lot of money involved in getting started farming, buying, your first herd of cattle, equipment. And sometimes whenever you look at those Schedule Fs, you can see that a big portion of that loss is because of depreciation. Going back to what I said before, One way to slow that depreciation down and minimize that loss is to potentially look at different methodologies to depreciate some of that equipment. Now we're going to switch to talking about how do we account for animals on the farm, and specifically market animals. Market animals are the animals that we are raising or we have purchased with the intent of selling and not keeping as breeding animals. When it comes to raised market animals, the cost of raising those animals are deducted in the year the expenses actually occurred. And then the sales of those market animals are reported on your Schedule F. They are treated as ordinary income and are subject to self-employment tax. So if you think about raising some steers, you will be deducting those expenses, the vet expenses, the vaccine expenses, ear tags, fly tags, feed expenses, as they occur throughout the year. And you do not have to accumulate all those expenses and keep up with that. Just as they occur, they happen, even if that animal is not going to be sold until the following tax year. Once again, market animals are ordinary income, subject to self-employment tax. They go right there on the Schedule F. On the other hand, if you've purchased market animals, so these may be animals that you have purchased at a certain weight and plan to add more weight onto those animals before you turn around and sell them, the cost of these actual animals, also known as the cattle basis, is only deductible in the year in which the animals are sold. So think about a scenario where you purchase some 5-weight steers in October of a given year, but you're not going to sell those animals until the following tax year, assuming that you're a calendar year taxpayer, which most farmers elect to be. Those animals purchased in October of the previous year, you cannot deduct the expense of those animals until you file your tax return for the following year. However, the other expenses that are associated with putting the weight on those animals, raising those animals, once again, the vet expenses, vaccines, tags, all those day-to-day expenses that are associated with raising those animals are deductible in the year that they occur, just like with raised market animals. So here's just a quick little infographic, so to speak, of what this looks like. Market animals, are they purchased? Yes. Original cost only deductible in the year that they were sold. Production deducted in the year of occurrence. Ordinary income subject to self-employment tax. On the no side, no, you have zero cost basis in those animals. Once again, that's because the cost of getting that animal born has already been deducted as it occurred. Production cost deducted in year of occurrence, and once again, it's ordinary income subject to self-employment tax. Here's just a quick example. Let's think about a Fiona farmer who purchases 25 head of 5-weight steers in November 2021. Total purchase price of $18,750. Fiona will feed those animals through the winter and sell the animals in 2022. All the feed, vet, utilities, expenses, etc. of those 25 head occurred in calendar year 2021 will be deducted as ordinary expenses in 2021. Fiona will be able to deduct the basis of the animals she paid for in 2021 on her 2022 taxes when the animals are sold. All other expenses occurring in 2022 associated with those 25 head will be deducted on her 2022 taxes as well. So let's talk a little bit about breeding livestock and how do we account for that on our taxes. When it comes to raised breeding livestock, the expenses associated with raising the breeding livestock are deducted as ordinary expenses in the year that they occur. So once again, if you have a heifer, for example, born and you identify that heifer as an animal that you want to retain as a breeding animal in your operation, you will just deduct those expenses associated with her day-to-day life, vet, utilities, feed, so on and so forth. All of that gets deducted in whichever calendar year that it occurs in. Because of this direct expense deduction that is allowed, you have no cost basis in that animal. The cost basis in that heifer that you've decided to retain will be zero. If the animals are held for 24 months or longer and then sold, the sale is treated as a Section 1231 or a capital gain. A lot of people are very familiar with the term capital gain because there is a more favorable tax treatment associated with that. If the animals are held for less than 24 months, but the intention was for them to be used in the breeding capacity, gain is treated as ordinary income but not subject to self-employment tax. So you can see as we get into the breeding livestock, we start hearing things about intention and time periods of holding these animals, and all of this matters because it can have a significant impact on your taxes. If we're talking about purchase breeding livestock, you have to consider depreciation recapture, because when you bought that cow or heifer or bull and set that animal up on depreciation over that 5-year period, that deduction each year was a direct offset to ordinary income. So if you sell a purchased breeding animal that's on depreciation, you have to recapture that depreciation up to the point that it was taken, and that depreciation recapture is treated as ordinary income, but it is not subject to self-employment tax. Here's an example. Fiona Farmer sells cows for $10,000 in 2021. She originally purchased in 2015 for $15,000, and they were fully depreciated when she sold them in 2021. Fiona shows an ordinary income gain of $10,000 on her Form 4797, which flows to her Form 1040 Schedule 1. Here's the second example. Fiona Farmer sells $12,000 of cows that she raised and held longer than 24 months. $12,000 is reported on her Form 4797, which is treated as a Section 1231 gain. Typically a favorable tax treatment for a lot of people. When you're selling both purchased and raised breeding livestock in the same year, depending on the specifics, a loss on one can offset the gain on the other. We also have to concern ourselves with what is known as netting of Section 1231 gains that must occur over the previous 5 years. The point here is not to walk through every possible iteration, as time simply does not allow for that. But what I hope to have informed you about here is the importance of keeping detailed records on cattle sales and purchases, because it's of paramount importance to report it correctly to the IRS for tax purposes, and it's of paramount importance for you to strategically manage your taxes lawfully and receive the best tax treatment depending on the specifics of your situation. One last thing that I will say, oftentimes as a farmer, we're caught up farming every day, raising the cattle, doing all the things that we need to do. Our cattle are our cattle. Just remember that that detailed information is really important, whether you're doing your taxes yourself or you're taking your taxes to a CPA or other tax professional. That tax professional most likely will not know, based off a sales slip from the barn, what animal was bought previously, which one you had raised. So all that information is super critical for you to keep track of, keep detailed records, and provide that to your tax professional. As always, please feel free to reach out to me. My contact information is on the screen. If you have any questions, I'll be happy to help. Thank you very much.